We're standing on shaky ground. The surge in oil prices and the ballooning federal deficit are flashing red warning signs. These issues aren't isolated, they're interwoven threads in a complex tapestry that could lead us into a storm. In the 70s, skyrocketing oil prices were a harbinger of economic turmoil. And now, as history eerily repeats itself, we're witnessing oil prices soaring again. It's got us thinking about the 70s all over again. The probability of a recession knocking on our door before the end of 2024 stands at a menacing 25%. That's a quarter of a chance that our economic woes will deepen, affecting jobs, businesses, and livelihoods. But here's the thing, recessions, while grim, offer opportunities. They're like clearance sales for savvy investors. When the market tumbles, smart money is made. It's a chance to snatch up assets at bargain prices. Now, let's break down the difference between a technical recession and an actual economic recession. The former is a mere hiccup in GDP, but the latter? That's when things get real, a prolonged slump, unemployment, and widespread suffering. Predicting a recession isn't easy. Over the years, forecasts have swung like a pendulum. Some were spot on, while others missed the mark. It's a bit like predicting the weather, you might get it right, but it's a fickle game. What should we look out for? Well, indicators, my friends. Treasury spreads, jobless claims, GDP growth rates, and consumer spending, they're our economic weather vane. Keep an eye on the labor market, it's our crystal ball. High unemployment? That's a storm warning. Rising oil prices, ballooning deficits, and growing recession probabilities, it's a cocktail of economic turmoil, and we must be prepared. In the past, rising interest rates have pushed us into economic downturns. Remember the 2008 financial crisis? It was a painful lesson on how rate hikes can hit us where it hurts. Excess savings may sound good, but it's a sign of cautious spending. Meanwhile, record-high credit card debt signals folks leaning on borrowed money. That's a dangerous balancing act. But wait, there's a silver lining in this storm cloud. Recessions come with a Federal Reserve safety net. They cut rates to jumpstart spending, and inflation takes a breather. That's a recipe for potential market gains. Unemployment claims and rates are crucial. More claims? More layoffs. More layoffs? Lower spending. It's a domino effect that could reshape our economic landscape. We won't throw numbers around, but let's just say there's a significant probability of economic turbulence ahead. We're in the calm before the storm. So, how can you weather this storm? Diversify your portfolio, don't put all your eggs in one basket. Defensive assets like bonds and reliable dividend stocks can be your anchors. Keep a long-term perspective, and be ready to seize opportunities when the market falters. Remember, recessions aren't just about doom and gloom. They're also about resilience and recovery. Stay informed, stay prepared, and you could come out of this stronger than ever. And before we wrap this up, don't forget to like and subscribe to our channel now. We're your beacon in these economic storms, guiding you through the turbulence. Stay tuned for more insights and analyses.